All right, let's jump right into this explainer. Welcome to the Advisor's Blueprint. We're cutting straight through the absolute noise of modern financial hype today, building a grounded, professional roadmap for your wealth. We're going to break down the complexities of the modern market so you can see exactly where the pitfalls are and, more importantly, how to navigate right around them. Here is our roadmap for today. We'll start with the rise of financial hype. Then we'll break down three major traps: the prediction market casino, the private credit illusion, and the geopolitical trading trap. Finally, we'll outline the actual steps to real wealth. Okay, part one, the rise of financial hype and the allure of fast money. I mean, we see this literally every day, right? We're constantly bombarded by influencers and AI bots pushing this illusion of effortless wealth. Just look at this quote from a recent viral pitch. Turn your little $2,000 tax return into $30,000 by buying tech and AI companies. These pitches deliberately prey on our emotions and our wallets. But pushing totally unrealistic expectations, like 10xing your money in 6 months, it just sets people up for massive failure, pushing them to take on even more reckless risks to chase phantom profits. Which leads us to part two, the prediction market casino, where people are just rolling the dice on the news. Let's look at how this hype breeds entirely new industries. Prediction markets have completely exploded recently. You've got platforms like Polymarket or Kalshi allowing users to bet on the outcome of future events. Will a pop star get engaged? Will a political event happen? You buy contracts with binary, all-or-nothing payouts. And while influencers advertise this as a great way to trade with an edge just by reading the news, the reality is you're essentially rolling the dice against anonymous insiders and hyper-sophisticated trading algorithms. The reality hidden behind the hype here is kind of staggering. An independent blockchain analysis found that 84% of Polymarket users actually realized losses. 84%! The vast majority of the profits are just being scooped up by a tiny fraction of pro users and institutions who have the infrastructure to exploit arbitrage opportunities way faster than anyone else. This really puts the risk into perspective. Look at this median ROI comparison from a recent gaming equity report. The median return for a retail user on prediction markets is actually a negative 8%. Think about that. That's worse than traditional, legal US sports betting, which sat at a positive 5%. You'd literally be better off betting on football. So the core thing to understand is the fundamental difference here. True investing is long-term, backed by actual business cash flows, diversified, and generally a positive-sum game. Prediction markets are short-term, binary, heavily insider-driven, and a negative-sum game once you account for platform fees. These platforms act much more like a casino than any sort of viable strategy for building wealth. All right, moving on to part three, the private credit illusion and the very real dangers of shadow banking. Now let's explore a more institutional trap that everyday retail investors are increasingly being lured into. Private credit operates in what's often called shadow banking. Basically, it involves non-bank financial intermediaries lending money directly to private businesses. This space grew incredibly rapidly after the 2008 financial crisis because traditional banks got hit with stricter regulations. So these non-bank entities swooped in, took on the riskier lending activities, far away from public market scrutiny, and started charging absolutely exorbitant fees in the process. And this market has exploded. It's grown tenfold since 2009 to a massive $2 trillion. It gets heavily marketed as a high-yield alternative to traditional bonds. But behind that massive $2 trillion number, significant cracks are definitely starting to show. Defaults are creeping up, and the totally opaque nature of these private loans is becoming a serious liability. Take a look at this timeline, which is based on real events in the private credit sector. Because these assets are not publicly traded, there is no real-time price discovery. So a loan can be given a perfectly clean bill of health by auditors, and then bam, just 6 months later, the company declares bankruptcy. The debt plummets below 20 cents on the dollar, and shortly after that, the loan is completely written off to zero. It goes from looking totally healthy to a total loss almost instantly, catching investors completely blind. And you know what happens when those write-offs hit? Panic sets in. When investors rush for the exits to get their cash out, these funds enact what's called gating. Gating is when a fund actively restricts investor withdrawals to prevent a fire sale of their illiquid assets. Imagine being in a burning building and finding the doors locked. Your money is entirely trapped inside these illiquid investments exactly when you want it the most. That brings us to part four, the geopolitical trading trap, or why you shouldn't trade the headlines. We see this trap all the time with global news. You'll have influencers screaming that you need to buy a specific defense stock the second a conflict erupts, or buy oil because a channel is blocked somewhere. But here is why that just fails. Institutions with nanosecond algorithmic advantages have already priced that news into the market long before you've even opened your trading app. Furthermore, geopolitical outcomes are wildly unpredictable. When you fixate strictly on a headline, you completely overlook the actual underlying fundamentals of the business you're buying. So let's lock in this core principle. Investing for the long term based on near-term headlines is fundamentally flawed. Wars and tariffs alone do not guarantee corporate returns. You simply cannot beat the market trading superficial facts without understanding how a company actually generates its cash flow and sustains its business over a 5 or 10-year horizon. I absolutely love this quote from our source material. A little bit is better than nothing. Once that little bit is consistent, we compound and increase it into more over a period of time. This hits the nail on the head. It highlights the exact pivot we need to make today. We want to step away from chasing volatile, heart-pounding news events and shift our focus entirely towards sensible, steady, long-term accumulation. Which leads perfectly into Part 5, Steps to Real Wealth, the Advisor's Blueprint. All right, let's translate all these critiques into a clear, professional procedure for your financial security. Here is your advisor's blueprint, broken down into simple, de-jargonized steps. Step 1. Build a 3 to 6 month cash emergency fund to cover unexpected expenses. Step 2. Aggressively avoid predatory setups like online copy trading or proprietary trading firms. They literally make their money off your failure fees. Step 3. Invest in broad ETFs or managed solutions that offer deep diversification. And Step 4. Hold for the long term to let the magic of compound interest do the heavy lifting for you. By sticking to this blueprint, you shield yourself from predatory environments and actually lay the groundwork for genuine financial freedom. Now, just a quick note on Step 1. Cash is a tool, not a long-term growth asset. Use it for your emergency comfort so you can sleep well at night, sure, but you have to deploy the rest into diversified assets to beat inflation. While wealthy individuals don't hoard excess cash that just gets eaten away by inflation, they certainly don't throw it at meme stocks, binary prediction markets, or opaque private credit funds either. They own assets that compound real value over time. Let's wrap this up. Your big takeaway from this explainer should be that slow, boring, and highly diversified investing is exactly what a fiduciary advisor wants for you. Disregard the viral cheat codes. Stick to transparent, highly liquid markets. Make sure your investments actually align with your personal risk tolerance. And always prioritize solid business fundamentals over whatever the hype of the day happens to be. I want to leave you with this provocative question, and I really want you to think about it. Are you steadily building real wealth for your own future, or are you just paying for a viral influencer's next vacation? Ignore the hype, focus entirely on the fundamentals, and consider sitting down with a registered fiduciary professional to review your personal financial roadmap. Thank you so much for joining me for this explainer today. Stay focused and, as always, be safe out there in the markets.